What's up, guys? Corbin here on Everything About Mortgage, and today we're going to be talking about California's famous down payment assistance, CalHFA, which is a great way that you can get in your home with absolutely no money down. So I'm going to try to keep this video short, concise, informative, straight to the point, and just have all the information that you need about the CalHFA loan. So let's get into this. First off, CalHFA, as I mentioned, is a loan only through California. Different states have different programs similar to this. CalHFA overall typically goes up to giving you a total of about 6.5% down payment assistance if you use all of it, which we'll get into. Typically, that ends up averaging out to about 4% or 4.5% of what you're actually going to get, because usually there's about a 2% charge on these programs overall. But that gives you a rough idea. So the first question I want to pose and then give you is, what is this product available with? So this product is actually available with FHA, conventional, VA, USDA. So it's not just a one size fit all. I'd say the most common use of it is your FHA and your conventional loans, just because those products have a down payment, whereas like a VA or a USDA loan don't necessarily have a down payment. So some people don't want to use this product for the VA or USDA, but this is a great option for your FHA and conventional loans. So there's a few basic requirements that you should know of. One, you have to be a first-time home buyer. And what is the definition of a first-time home buyer? This is really important. It's somebody who has not lived in a primary residence or owned a home in the last 3 years, or spouse hasn't owned a home. There's a few restrictions on the CalHFA loan that we need to talk about in those basic requirements. One of them is you can't have a non-occupant co-borrower, and you can't have a co-signer. They're almost the same exact thing. So if you needed more income to help qualify for this product, you wouldn't be able to add on a parent or a friend or a family member to help you qualify for the product. The minimum FICO score is going to be 640 on this product. So we can talk about credit repair in another video and how you can get your credit up to where you need it to qualify for these programs. But if you're at 600 or so, feel free to reach out to me, and I can actually help get that credit up if you need me to. The only difference with the credit scores is if you're buying a manufactured property, which you may not know what this is, but we see them oftentimes in the Central Valley over here, like up in the foothills. It's more of like a double wide or a multi-wide, almost like a mobile home, but a little bit different because it's affixed permanently to the ground. And that FICO requirement is 660. So you have to have a 660 FICO to use the CalHFA products. So let's get into the debt to income ratios and what that is. So we've talked about this before, but what is debt to income ratio? Debt to income ratio is basically just the mortgage payment divided against your overall gross income. And that number, if you have a 700 plus FICO score, has to be below 50%. If you have a 700 or below FICO score, that number has to be below 45%. One thing that's also important about debt to income ratio is it's going to include your monthly debts. So oftentimes people think, oh, I have $100,000 of debt, I'm never going to qualify. But what you don't understand is the lender actually looks at the monthly payments. We're not going to take into account the fact that you have these huge balances. We're going to look at more of the fact of what is that monthly payment and where does that take you in your debt to income ratio percentages. So we can have a whole video on debt to income ratio, but we're here to talk about CalHFA. There's a couple different products with the CalHFA loan that you could potentially qualify for. One of them being the My Home and one of them being the Zip. Both of these products are silent seconds, or one's a silent second and one's a silent third. And what does that mean? That just means that there's a lien on your home, but you have to eventually pay it back. So it's not free money in the sense that they're just giving you this grant and you don't have to pay it back. It is something that you have to definitely pay back. The My Home usually goes on as a second, gives you typically 3.5%. Whereas the Zip, standing for zero interest program because there's no interest on it, is going to give you typically anywhere from 2 to 3%. And if you go on the CalHFA website, you can Google CalHFA rates, and it will actually pull up their rate sheet because CalHFA determines the rate based on the product that you're getting. So if you're getting a 2% Zip, you're going to get a little bit of a better rate than if you're getting a 3% Zip. So what does silent second mean, or silent third? This is often a question we get asked. All that means is there's no monthly payment on it. there's a lien on your home that you have to eventually pay back. So this is a really important piece. This is something that a client actually recently asked me about, is refinancing. Can I refinance the interest rate? Because as we know, interest rates are in the 7s or 8% right now, which can cost people's buying power to not be where it's at or where they want to be, or just cause their monthly payment to be higher than they'd want it to be, and they want to reduce their monthly payment when the rates come down. Unfortunately, this is a very, 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 very important part. You cannot refinance on a CalHFA loan. So this is a big sticking point that a lot of lenders and loan officers sometimes don't tell their clients, and they need to know this, that you cannot refinance that mortgage unless you pay off those liens. So you can do a cash out refinance if there's enough equity and use some of that cash to pay off those liens at close, but you cannot do a rate and term, which is just where you're reducing your interest rate. It's super important. Like I mentioned about interest rates, those are going to be depicted on the program that you use with CalHFA. So I definitely go on CalHFA rates, like I mentioned, and just kind of take a look at their products. And you can search the website. You can click on the different buttons and it will show you what the different products offer. So, and wrapping this up, let's talk about some of the pros and cons of these programs, as you can see. So the pros is you can get into a home with very little cost. And here's something cool about this. If you use the CalHFA product, let's say you use the My Home and the Zip, and let's say there's about $4,000 to $5,000 left over, because these products, by the way, are never going to typically cover 100% of everything. They'll cover almost everything, but they typically don't cover everything. In this market, where maybe demand has dropped a little bit, maybe you could ask that seller for $4,000 to $5,000 in closing cost, and you can use those closing costs, getting yourself in the home with no money down. Another great part about this product is, as a lender, we can close this as fast as we can close a normal loan. So my point in saying that is, it doesn't make your offer weaker. If you submit an offer to a seller, you can tell them, hey, we can still close on a strong timeline. We can still close in 21 days. And the CalHFA product should not affect that at all. Now, here's the cons. It costs you more money in the long run to do this product. So if this is a product where you don't have the money to come up front, and you want to get a house, lock in that appreciation that you're going to get over the next 4 to 5 years, then this is the product for you. If you have money in the bank, you may want to consider using your own funds to purchase a home so that you're not paying more in the long term on this. You have no equity in your home at the beginning. Because you have a silent second and a silent third, and the down payment's only 3.5%, you are technically underwater a little bit in that home, which is very important to note. So you're going to have to wait a while for your home to appreciate if you want to sell. Because if you sell with those products on there, you're going to have to basically come out of pocket to pay your realtor, which is scary, right? If you're selling a home with a realtor. That's something that you should definitely consider. And the huge one, you cannot refinance. So just know that if you get this product, you cannot reduce your interest rate and get your interest rate down when everybody else is getting their interest rate down $300 or $400. You cannot get your interest rate down at that time. So it's up to you, really. Do the pros outweigh the cons for you, or the cons outweigh the pros? Make that decision yourself. If you have any questions, you can reach out to me here, my team. We're more than happy to assist you and help you with any sort of mortgage loan. We do more than CalHFA, of course. We do FHA, we do VA, we do USDA, platinum grants. We do much more. And in further videos, we're going to go into all that. So I hope that this video was informative and short and to the point. If you have any questions, let me know.